We do have one question online from Gerald M on YouTube. He is asking, I have a $410,000 mortgage. I would like to pay it off in 5 to 7 years. I have a 2.75% interest rate. How can I do that?
You can definitely do that, but I'm going to give you just a hint by putting your information in here. On the screen right now, you see $410,000 at 2.75%. The payment, just the principal and interest payment, is $1,673.79. You want to watch the replays on getting the step-by-step, the play-by-play. But what we're talking about is knowing how to manage your funds. I'm going to talk about it this way. When it comes to paying off your debt, we want to control the interest cost, and we want to do it with your current budget. You don't need more money to get out of debt. You need to pay less interest. Here's how we look at it. Number one, with the P.I.L.L method, is your lifestyle money, the money that you and your family spend so that you can enjoy life. Vacations, whatever it is that you're doing, taking the kids to the museum, going to the amusement parks, whatever it is that your family is doing to have fun. That's number one, lifestyle money. Number one. The next underneath that is the money you're putting away for savings. So we're budgeting all this. You tell the program how much you spend on this per month. Then we're going to say, okay, how much are we spending on savings per month to put that away? Underneath that, how much are we spending on making the minimum payments on our debt? Okay, just the minimum payments on the debt, we put that into the program. Then the last thing we put into the program is how much does it cost to round out the rest of the budget? Food, electricity, your cell phone payments, things like that, things that you have to pay for just to be able to live from month to month. Your regular monthly bills, TV, all of that go in. Okay. Now, once you do all of that and you're tracking how much you're spending and how much you're making, then it's easier to figure out how much you have left over after all the bills are paid. Our program then will instruct you on how to put that money into your savings account. You just transfer the extra money into your savings account. Every 2 or 3 or 4 months, depending on the family or business or church that's using this program, the program will say, oh, we have enough money saved up. Let's apply that to principal on a particular loan. The program is going to help you to choose which loan we're going to attack. It's going to help you to know how much money exactly to the penny to apply to that loan, what month to do it in, what day of the month to do it on, and we're going to figure out your interest savings so you can save the maximum amount of interest per dollar. When you do that, our program will tell you from day one how much interest you're going to save and the month and year you're going to be debt free. In fact, we'll even give you the date, the month, year, and the day you're going to be debt free by following this program. And it's usually within a 7 to 9 year window. But just looking at this loan here, okay, where we have principal payments of around $700. If we make this very first payment on line 1, we see the principal payment on line 2. What if we prepaid the $735.89? We just give that to the bank early. We know we have to pay it eventually, but let's just say we give it to the bank early. In the same month, we make our regular payment. Do you realize that we skip right over this $937.90 in interest on line 2? We never have to pay that. We just got rid of line 2 on this schedule for $735. And now we're on line 3 for the very next month. Folks, this just gives you an idea of what happens when you prepay. We know we can prepay. We know we can pay early. We just don't know what happens when we do. If more people knew that you can figure out when to pay so that you can save the maximum amount of interest per dollar, let's just say we figure this thing out. And the maximum for you would be, I can save $6 in interest for every dollar I apply to principal in the right way. What? $1 saves me $6 in interest I don't have to pay? Well, then that means $2 would save me $12 in interest. I mean, just multiply it from there. All right. But what if you didn't have a calculator to tell you when to apply it to get $6 in savings per dollar? What if you were doing it on your own and ended up getting $2 or $3 in interest savings for every dollar? You're saving. You're definitely saving, but you're not tracking. You're not measuring. And folks, you can't optimize what you cannot measure. And we've been taught not to measure. We have given you the tools now that you can measure to make sure that you save the maximum amount of interest per dollar. And that is the opportunity cost calculator. And here's what you're going to do. Now, please go to ice10k.com. All right. And then I'll take you to my digital business card. When you get to the digital business card, click on the button that says Get a Savings and Earnings Report. Fill out all the information there. Someone from my staff will get with you, and then we will set up a consultation. At that point, you will then know the month, day, and year you could be debt-free and how much interest you're going to save. And then, just so you know, the amount of interest that you save for most of our clients is somewhere between $100,000 and $150,000 in interest on average that they'll never have to pay. We get a small percentage of the interest savings that you were going to pay the bank. In other words, we're going to get your bank to pay your fee for your lifetime program. In interest, they're no longer going to receive. How do you like them apples? All right.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.